All right, listen up. I'm Steve, and welcome to today's Explainer. You're going to want to pay close attention because today we are doing a full autopsy on a massive, high-volume rocket ship ride on the tape. The market didn't just stabilize into today's session. No, it staged a violent, multi-asset, short-covering squeeze that completely rewrote near-term resistance levels. Now, while the mainstream news is out there scrambling to chase the green bars, our job on this desk is pretty simple. We track the hard numbers, and we look at the exact mechanics that shifted this capital. So let's crack open the ledger.
Right off the bat, we gotta look straight at the board, because the bulls didn't just take the wheel today, they absolutely stomped on the gas. 2%. That number right there means the S&P 500 futures shed the red and literally screamed higher. Look, when you see a move of that magnitude, you know for a fact it's not retail traders. That is heavy, institutional capital stepping in hard.
You can see the sheer violence of that capital shift across the board right here. Check out these exact settlement prints. S&P futures locked in a true settlement, right at $7,412.50. Meanwhile, spot gold surged over 2% to snap back to $4,281.30. And Bitcoin caught this massive risk-on wave, expanding over 2.5% to trade back up at $63,344.32. The screen suddenly flashed blinding green across the board, but to actually understand why, we have to look at the internal tape.
Section 1. The breakout.
Just look at the sheer velocity on this 5-minute S&P chart. After some early consolidation, boom, we get these massive, aggressive green bars. Notice that volume profile at the bottom of the chart? Those giant gray spikes indicate programmatic desks aggressively hitting the gas. The price action just violently tears through those blue VWAP bands and doesn't even look back. That right there is textbook short covering panic.
Section 2. Behind the curtain. The catalyst.
So what actually sparked this? Well, for the last few sessions, programmatic desks were pricing in some severe war risk premiums, due to the military exchanges between the US and Iran. The street was absolutely terrified of a permanent supply chain lockdown. But today, the White House completely flipped the script. They announced a sudden de-escalation framework and froze offensive operations. The exact second that headline hit the terminals, the risk premium just evaporated.
Now here's the exact mechanical chain reaction of how that played out. First, that diplomatic breakthrough hits the terminals. Second, millions of dollars in defensive short positions are instantly trapped offside, literally caught in a net. Third, automated market makers are forced to aggressively buy back futures contracts just to clear their books. And fourth, that mechanical short squeeze acts as the exact rocket fuel that sends equities completely vertical. It's a forced unwind, plain and simple.
Section 3. The macro release valve.
Take a look at this massive divergence. While equities skyrocketed 2%, crude oil went into a state of absolute free fall. The active July paper contract for Brent crude, ticker BZN26, collapsed nearly 4%, plunging straight back down to anchor at 91.89. This massive divergence, the S&P surging while Brent tanks, that is the macro release valve blowing wide open.
And why does that actually matter to us? Because the collapse in the oil premium acts as an immediate, systemic corporate tax cut across the entire S&P 500. It's a game changer. Lower input costs and cooling logistics pressures mean the corporate profit margins instantly expand. The fact that oil bled out while equities surged is giving the bulls the exact fundamental ammo they need to hold these levels.
Section 4. The yield relief bid.
Over in the fixed income pits, the 10-year Treasury yield caught a strong bid and backed down to 4.52%. When that risk-free rate cools off, even by just a few basis points, it does something very specific. It lifts the automated valuation ceiling on tech and growth equities. Remember those mega-cap software and chip stocks that got absolutely hammered last week on dilution fears? Yeah, they used this yield relief to stage a massive counteroffensive today, acting as the primary engine for the entire index bounce.
Section 5. Professional Trading Directives. All right, so here is your blueprint for tomorrow morning. First off, stop chasing green rockets. Let the algorithms do that, okay? We trade the hard moving averages. Today's spike means the S&P futures aggressively reclaimed the 20-day simple moving average. But more importantly, we firmly defended our primary structural anchor, the 50-day exponential moving average. As long as we hold above that 50 EMA, the bull market is structurally protected. Keep tracking that July crude contract at 91.89. Suppressed energy clears the runway for equities ahead of the FOMC meeting. Above all else, respect your stop losses and manage your position sizing.
At the end of the day, the numbers dictate execution, and the ledger doesn't wait for latecomers.
The mechanics of today's squeeze are crystal clear, our levels are set, and the risk parameters are strictly defined. So, the only question left on the table is, when the volume floods in, are you ready for the morning bell? Think about it. Thanks for tuning into today's Explainer. Keep your stops tight, and I'll see you in the pits.